Yesterday we saw a percent or so decline in the markets, but week to date still flat. Yesterday's move, was that because of this trade story, or was it because of the global growth downgrade as an outlook?
I think the news flows from trade. I mean, because if you're looking at the data that's coming out, it's really hard to see bad news. Payrolls were good. Consumer confidence is still really high, even with the shutdown. Earnings growth is coming in at the mid-teens, so it's not 25%, but it's still pretty good. I was sitting yesterday looking for some bearish sign. I found the Baltic Dry Index decline. That was about all I could come up with.
Wow, so you're still pretty bullish on U.S. equities?
Yeah, I mean, just use some simple math. Let's just suppose you thought we would get back to levels that we were at the beginning of Q4. So with 10 or 15% earnings growth, by definition, that's a 10 or 15% PE contraction. I think that's very reasonable.
Albeit, I guess, Hank, markets are more forward-looking than just this current quarter. Do you think earnings growth can continue to deliver those sorts of growth numbers?
Well, I think earnings growth is going to be positive, and that's the most important aspect. Obviously, the rate of growth is down dramatically from last year, but it's still going to be positive. And we totally agree with Simeon that this market pullback yesterday is all related to trade. In fact, if you want to go back to the fourth quarter correction near bear market, it was all self-induced based on misstatements by the Fed and then trade rhetoric that turned into actual tariffs and the threat of a trade war with China. Now we've put the building block with the Fed back into place. They've stepped back from those aggressive comments in early October, and now all this bull market needs is for trade to come off the table, tariffs to come down, and an agreement with China to be put into place. And I think you're going to see this bull market resume in a very healthy way.
So, Hank, how are you positioned? What's the kind of the trade between value growth or which sectors really stand out for you?
Right. Now, if you look at the market last year, you had bear market returns in the more cyclical sectors, such as industrials, basic material, financials, even tech to a certain extent. So we think that's where the opportunity is today. And you've seen a big rebound year to date in some of those sectors. At the same time, I think you do need a balance between offense and defense. So you can't go all in with the cyclicals. You do need some defense in the consumer staples and healthcare sector as well.
Simeon, the big tech stocks have been a large part of the rebound since Christmas. Can that continue?
I think it's wise to be a little wary there. That tech is the weakest sector in terms of earnings growth in this season. Top line's only up 1%, earnings up only 6%. So yes, they're rebounding from Q4, but I'm not sure that that's a great play going forward.
Ed, what's your take on that sector? I mean, we did see a very nice intraday recovery for Google after they missed. It shows there's a lot of buyers out there.
They were beating on the top line this quarter, and I think that was a positive sign that it wasn't happening in Q3. So I think there was a bit of upside on that, but at the same time, given just the geopolitical issues and sort of worries about regulation, that's I think, going to overhang. Yeah.
Simeon, just quickly on the international picture, you like EM over the developed market internationals?
If you go back to fundamentals and look at the income statement and balance sheets, EM has actually worse gross margins than developed markets, but better returns on capital. That seems like a pretty reasonable formula. If top line is weakening and growth is weakening, those better balance sheets should play well.